Welcome you all to the first session of the afternoon. We needed probably to do a little bit more work on our title. We're talking IAFE liquidity risk paper. It's competing before us with the thoughts of Jack Trainer and Peter Bernstein. This afternoon there's a topic which is 5 trading ideas for today's market. Somehow or another, I think we kind of at least lose a little bit in the advertising. About a month or two ago, the IAFE decided to organize a working group to basically look at the implications, especially from a financial engineering perspective, of the recent market turmoil. Back in December, we had a liquidity risk symposium, which I think my title was something like, the crisis of 2007. It turned out this spring, Rich and I were at a conference at Vanderbilt, and when I originally got asked to speak, again, the title was The Crisis of 2007. By the time I spoke, basically it was the crisis of 2007-2008. And as we sit here today, I'm wondering if I'll need to change that again come, the end of the year. It's nothing else. The events that we've been going through in this current liquidity crisis are in many ways unique, in many ways unprecedented. Certainly the longevity of them and some of the sudden and severe results have made a lot of people much less complacent about the way that we look at a lot of these markets. And so the idea was that, we should basically try to, the IAFE should, put some of its thoughts down. How can financial engineering help and benefit in terms of avoiding these in the situation? How have we potentially contributed to some of the problems? So that's basically what we're doing here is we're presenting, in a sense, some of the questions we're looking at, some of the outline of what we intend to do. The working group is 4 members, 2 academics. We've got Chester Spatt from Carnegie Mellon, also just not too long ago, the chief economist at the Securities and Exchange Commission. We also have Pierre-Olivier Weil from UCLA. So those are the 2 current academics. The 2 practitioners are myself and Andrew Davidson. Andy's an IAFE advisory board member and president of Andrew Davidson & Company. He's one of the leading experts in the modeling of a lot of the securities that we're going to be dealing with as part of this process. As you look at this, you kind of try to step back, and in some ways it was kind of an interesting walk over here from our offices on Park Avenue for this. Two things happened just by coincidence, and I'll tell them in reverse order of how they occurred. The second one, I walked past what used to be the beautiful Bear Stearns building. And it's amazing how quickly, no longer is their name anywhere, but J.P. Morgan's name is everywhere on this building. It didn't take very long. And it kind of epitomized how quickly things have changed as a part of this crisis. The second one I found very interesting for a couple reasons. I'm walking past the J.P. Morgan Chase building on Park Avenue, and there's a person outside, well-dressed, with a sandwich board on. Now, it's probably staged because there's a person there with a camera and everything going on. But the sandwich board basically says, effectively, it was advertising, hire an MIT graduate. Now, I found that interesting given the location, given what we're going through. I also found it a little bit disturbing because I have 3 degrees from MIT, so I didn't like the trend. Anyway, that's kind of, the setting for what we're dealing with here. Okay, good. But if you need it, if you're looking, he is over there giving out resumes. So I think a couple things, just as caveats to start this. One is, I think it's important to separate financial innovation, the role of it in this process, from the role of governance. Okay, it doesn't mean that both don't have their portion to blame, but a lot of the problems that we're dealing with really are much more, I think, fall in the camp of governance as opposed to innovation. You're dealing with things like underwriting standards, the lack of standards, or even the fraud associated with those. Maybe financial engineering helped enable that, but it didn't cause those standards, create those standards. You look at the aggregate exposures of a lot of the financial institutions, both on and off balance sheet, the exposures and the commitments that got built up, the dramatic increase in that. Again, financial engineering probably was an enabler of that, but it wasn't the cause of this. I mean, you're dealing with all the incentives and all of the profit motive, and those are the kind of things that you have to deal with as part of this. You have to deal and try to understand the trade-offs from the incentives of the system. Now, if you kind of step back and look at some of the important points kind of that, underlie what we're looking at here as part of this liquidity crisis, and you're looking at some of the securities that we're going to be dealing with. We talk about this from a liquidity perspective, but truth be told, there's a couple of things we need to kind of think about. In many of the markets we're talking about, and certainly in the securitized product market, okay, those markets in question were probably never liquid. There never was a lot of trading. In most cases, the securities were placed with the intention that they would be held to maturity. Okay? That's not necessarily something that is a problem, except in cases where you need liquidity. And if you need liquidity, in other words, you're forced to sell, and they never sell anyway, you probably have a problem. Okay? One of the things you deal with in a lot of these structures is basically when you're talking about liquidity, who are the alternative buyers? Who are the non-traditional buyers that you can bring into the system? In this particular case, it probably is more difficult than normal. As you're looking at the person who's kind of the next best buyer, that next best buyer of the kind of the normal people that are involved in owning these securities is 10 or 20 points away from where the market is, and I've got 10 or 15 times leverage on a position, that probably is not going to work. It's something you have to think about what that means in terms of what is the substitutability of buyers, who can be attracted at a price to buy these securities. If you don't have a good answer for that, it's probably going to be difficult to deal with when you're forced to sell. Another issue that we've talked about, kind of has become kind of a theme in a lot of these cases, is this, or a bogeyman in some of these problems, is this idea of originate to distribute. The idea that you're doing these products and you're not holding them yourself. Now, that has some moral hazard issues associated with it, there's no doubt about it. But it's also the case that a lot of the markets that we deal with on an everyday basis, that's the model. It's an originate to distribute. Corporate bonds typically are originated to distribute. Equities are originated to distribute. So that's, why are those markets different? And what is the different implications? The second part, which I guess is also probably worth bringing up, is that the idea in a lot of these markets of this originate to distribute model may not have been quite as true as we thought it was. For example, in a lot of the structured products, a friend of mine basically works at one of the major banks. He told me that for a lot of these structured deals that they're doing, they were a big player in some of these things. Turns out they owned, after the fact, 80% of the financings. 80% of the structured product was still either on their balance sheet or in some way their responsibility. They owned them. Now, most of that was AAA. Okay, and there's some issues we'll talk about with regard to that as well. But for the most part, again, you now have to talk about what were the incentives, what was the overall system. It was basically a system of generating fees. And if I can do that in a way where I can effectively park a lot of these positions with low-cost financing, with relatively easy regulatory environment, as long as I can pay my financing costs, the fees are all profit. So that's the kind of structure you're dealing with as well in some of these things. One of the issues, I guess, broadly speaking, that kind of deals with all of these is the concept of complexity. Financial engineering does not necessarily have to mean complex. Some of the most successful examples of financial engineering are very simple transactions. A plain vanilla swap is pretty simple. You have a fixed payment and a pegged floating payment. One of the most successful contracts is the S&P futures contracts. Again, it's easy to replicate. It's a relatively simple contract. It's easy for most people to understand what's going on. A lot of the contracts we're dealing with today, and a lot of these structures that we're dealing with, have embedded in them an awful lot of complexity. lots of layers of complexity. You're dealing with when you're not only doing the pooling and you're basically tranching, you're bringing in, when you get into some of the synthetics, you're bringing in reference pools. You're basically, all of these things are combined in ways which makes it very difficult for a alternative buyer to really understand potentially what they're buying, and it makes it that much harder to find somebody to buy them when you need to sell. In a sense, one of the questions we always ought to be asking ourselves when we're looking at the role of financial engineering from the point of view, from at least from a societal point of view, is what is the benefit? In this particular case, what is the benefit of some of the added levels of complexity that we're dealing with? And when we talk about the benefit, we ought to be talking about it not to one party or another, but in the net. In other words, if the benefit is to one party because they can fool another one, that's probably not a good long-term solution. But those are the kind of issues you're going to be dealing with here. You kind of go back to some of the events that we just lived through, and basically, I'm an MIT graduate, so I hate citing anybody from Chicago, but I'll do it anyway. We're dealing with kind of the uncertainty or the unknown, almost from a Frank Knight perspective, where you think about, in his particular case, he was talking about unmeasurable uncertainty. One of the events that we kind of just lived through, one of the reasons that you've seen, if you talk to a number of the decision makers at the Federal Reserve after the Bear Stearns, if you want to, depending on who you're talking to, bailout, although Rich would say it wasn't that great of a bailout considering what happened to the stock price. You're dealing with a situation where, from their perspective, even some of the people who were probably 6 months ago would have been adamantly opposed to almost any kind of a bailout, felt they had to do something because of that. The unknown, in this particular case, it wasn't with regard to the equity holders, it wasn't necessarily with regard to the creditors. It was with regard to counterparty risk and the implications of all of a sudden having to terminate contracts in the event of bankruptcy, and the cash flows associated with those contracts, and all of the implications that would have, and the unknown implications of that on the economy as a whole. That was their biggest concern. It was very interesting that in the last few weeks you've seen something coming out that the Fed was basically working on ways of trying to deal with that clearing mechanism, that counterparty mechanism across a number of the major counterparties as part of this process. It was very clear from the conversations over probably too many glasses of wine that was the thing that was their most concern, that was what they were looking in ways of trying to avoid having to deal with this again in the same way. Those are the kind of issues that we're dealing with here. The session here, again, think of this not necessarily, the opinions you're going to hear from the panel are ours. They're not necessarily those of the IAFE, they're not necessarily those of the working group. Okay? But basically the idea is to give you an outline of some of the things that we're going to be looking at as part of this, some of the questions, and at least some initial ideas on what at least the three of us think about that. Now, as I told you before, there are 4 members of the working group. There's 3 people on the panel, one of which is not even on the working group. We've got the 2 academics, it's interesting, have found better things to do this day than, okay. And it's interesting how this worked out. You've got Chester, who teaches at Carnegie Mellon in Pittsburgh. His previous engagement is that he's out in Hawaii at the Western Finance Association meetings. Tough competition, but he had to think a little bit hard about which way he was going, and as he was flying out, he waved to us. Going the other direction from UCLA, you got Pierre Olivier. He's gone to France, so they probably crossed in air and kind of both flew by us. But we're fortunate to have to help fill in this. We've drafted Rich Lindsay, chairman of the IAFE, president and CEO of Talcott Consulting. Rich, as all of you know, is a former president of Bear Stearns Security Corp, and I want to make sure everybody realizes that he left there 18 months ago. He's also former chief economist and basically head regulator at the SEC for markets. So he's got a lot of expertise in the issues that we're talking about, especially these of the credit and the counterparty risks, and the whole clearing mechanism, which has become an important underlying risk as part of this system. The other member of the working group that is here is Andy Davidson. Again, Andy is president of his own company, Andrew Davidson and Company. They are one of the leading providers of software and modeling for a lot of the different structured products that we're dealing with. So he's basically had to live with a lot of the minutiae and the details that really are at the heart of a lot of the issues that we're dealing with here. We've divided at least the outline up into 3 sections, and we're going to divide this up in the same way. Andy's going to go first. He's going to talk about securitization. Rich is going to go second, and his topics, price discovery, counterparties, and clearing. And then if there's any time left, I'm going to go and I'm going to talk about evaluation and risk assessment and potentially dynamic strategies and their impact on liquidity. With that, I'm going to hand it off to Andy.
Thank you very much. It obviously has been a quite difficult year in the mortgage and related asset-backed markets, and a lot of hand-wringing and thinking. And what we've noticed over the last month or so is that a lot of people are now trying to delve into what the basic issues are and start to think about what should be different in the future. What are the causes? What are the problems? To me, it still seems like too many people are trying to fix sort of the old problems rather than think through what the new structure of the market will be. So our focus today, in terms of this liquidity paper, is to think more about what the questions are than the answers. And in terms of questions, what I was trying to focus on is, in what way did financial engineering contribute to the problem? What way is financial engineering part of the solution? And how can financial engineering work to both avoid the problems that it may have caused, as well as be a broader solution to the problem? So in thinking of that, I generally split up financial engineering pretty arbitrarily into 3 different categories. One is securitization, and by securitization I mean the separation of the origination function from the investment function. So anytime one guy originates and someone else invests, that to me there's some sort of securitization that took place there. The second is structuring. Structuring is taking cash flows off of whatever these assets are. My focus is generally mortgages, but it could be car loans, auto loans, credit card loans, but anything that's creating some cash flows, and then you split those cash flows among different investors to achieve either some risk management goal or to take advantage of some arbitrage or whatever the other reasons might be. And then the third type of financial engineering is derivatives. And by derivatives, I mean index contracts. So those would be things that are zero-sum game. So ABX is sort of the main derivative operating now in this asset-backed mortgage market. But any futures and options, swaps, trades, credit default swaps are all these index contracts. So it's a side bet away from the underlying asset. So it's indexed to that asset. So you can think about each of these and think, okay, what's the good and bad associated with all of them? We all know the goods associated with all of them because we all market those, to the world as to why we're in this area. But some of it's worth reviewing. So securitization. So clearly securitization is good in that it increases the amount of funds available to create assets. That otherwise, the origination expertise is in one group of people, the cash or investment is in another group of people, and the two never come together. And so a lot of our financial flexibility is premised on the idea that once an originator has created a good asset, he doesn't have to hold it forever. He doesn't have to take all the risk. He doesn't have to provide all the funding. Someone else can do that. But it seems that in at least the subprime market and some of the other mortgage markets, that separation of origination and investment went too far. It's supposed to have a process where we go through brokers, and there's underwriters, and there was rating agencies, and there was deal structurers, and investors. And it's supposed to be a system of checks and balances, but to me it just became a system of checks. The broker got a check, the borrower got a check, the rating agency got a check. So we basically had everyone making money off of this without anyone sort of controlling what the risk levels were. And so to me, one of the issues I think for us to study is how far can we go on separating origination from investment? What mechanisms do we need to tie the originator back to the investor to make sure that the quality of information is good, the quality of underwriting is good, and so that the investor is only taking on the risks they intended to take on. They're not taking on risks of fraud or that the borrower doesn't exist. They're just taking on the economic risks associated with uncertainty of income, changes in home prices, and other things that the investment community should have. And to me, reps and warrants, I don't know if it's more technical than you want to discuss today, but the role of how that guarantee basically from the originator gets transmitted to the investor through what we call representations and warranties in the mortgage market is something I think that we should be addressing in this question here. In the second area, also feel free to interrupt, object, add on as you like. In the structuring area, we think of like structuring is good because we basically have different types of risks that are embedded in each asset. So one thing is that every asset needs to be funded. And so you want to create the funding portion and see if you can separate that out and get that to people who don't want to take risk but have cash flow and just want to earn essentially a risk-free rate. Then we want to separate out interest rate risks, convexity risks, prepayment risks, and credit risks, and so to get those risks all to the players who want to take on those risks in the appropriate form. But if you look at sort of the securities we got to, we ended up with like very, very finely tranched securities with very complex structuring rules. And the question was, what was the benefits of doing that, and then what are the costs? So how much did we gain in sort of more accurate pricing, and versus how much did we lose in liquidity and the ability to make these instruments transferable? But there's always going to be some trade-off between liquidity and customization, right? So you have one big pool of assets that's all the same, it's going to be pretty liquid, but it may not meet anyone's needs. But so you're going to always have to fight that trade-off, and maybe we went too far in one direction, maybe not. What was interesting is that, we went so far in this customization that each instrument was unique, so many of them were placed into CDO structures, there virtually was no trading in these instruments, as described earlier. But we then developed this new thing called ABX, which basically got rid of the customization, right? So you just take 20 bonds chosen by some dealers, put together, average the AAAs, average the BBBs, average the single A's, and say, well, let's just trade that as something that everyone can look at. And that instrument actually added a tremendous amount of liquidity into the market. It's still probably the only thing really trading in the non-agency markets currently. And then so the question comes from ABX. Was ABX the cause of the meltdown? Like, did creating a vehicle that people could short, that would cause the meltdown? Or was ABX really a great source of liquidity and forced some rationality into an otherwise irrational market? And depending on what position you had in ABX, whether you're long or short, you might have different views on that. Right now, what's interesting is if you talk to people at the pricing services, they'll tell you that they're pricing virtually every instrument, every non-agency mortgage off of ABX, not because they think it's the right thing to do, but because it's the only thing they can do. So that this, ABX instrument, which is clearly a complex financial derivative that was created through, based on structure, based on securitization, off of complexly structured securities, then turned into credit default swaps, another level of abstraction, and then combined together. It's a fairly complex instrument, but it's probably the most liquid thing in the market right now. So it shows that like complexity and liquidity don't always have to be opposed to each other if you've constructed the securities correctly. So those are some of the areas we're looking at. But what I want to do is sort of take like the big picture view of this and step back and say like, well, what is the impact of financial engineering, and what can make it good or bad? So often financial engineering arises out of some arbitrage that someone sees. Like there's an opportunity created to make some money, right? So most of us in the financial markets, we don't create instruments because we think it would be fun to create that instrument. We create it because we think we're going to make some money by creating that instrument. And so what is the sources of arbitrage? So it could be just misperceptions about value. It could be that there's different segments of investors who have different preferences. Could be something in the tax code. Could be something regulatory, or it could be something relating to ratings. And then we've been trying to think through under what cases does financial engineering sort of get into that arbitrage and reduce it, right? So you make your money, and as you increase the volume of financial engineering, you actually decrease the arbitrage, and so it vanishes. So you're creating greater inefficiency. When does financial engineering just sort of take advantage of something and doesn't really do anything? It just becomes sort of a permanent wealth transfer. So you can imagine, for example, some tax arbitrage where you could just sort of continually take money from the federal government because you restructured things from one way to the other. And if the government doesn't catch on, you just keep doing more and more of it. So it's just a steady flow of income. And then when does the financial engineering serve to increase the risk of the system? So there's situations where the more you do, and if you have dealing with index contracts, for example, there's sort of an infinite amount you can create. Right? So at least on mortgage loans, you have to build the houses before you create a new security. If we want to create a swap contract, credit default swaps, we can create any amount of credit default swaps that we want. We can place one with investors who are on one side of the arbitrage, one with someone on the other side of the arbitrage, and just continue to extract that out. But can you get to the point where that activity of growing so much can actually be destabilizing? So, I just sort of thought through this sort of random example that, went through my mind. So suppose, for example, there was some like ratings arbitrage, maybe like with CDOs or something. You could take BBB bonds, turn them into AAA bonds. And suppose it was like a good place to do that was creating subprime asset-backed securities. So you could create a lot of BBB bonds there. But good thing about, but to do that, what you'd have to do is sort of create a lot of these loans because there weren't enough loans to fill all the demand for the ratings arbitrage. So you do like extra loan origination. You just drop rates on loans, originate more and more loans because you have this tremendous demand for these BBB assets. So suppose that leads to home price appreciation. I sort of feel like I'm talking Jack Trainer's talk this morning. But suppose that leads to home price appreciation. And so what's good about that is that we still have several things going on. We have these increased volumes, but they're making these products more and more liquid. And because they're more liquid, the spreads are actually falling. Because home prices are going up, realized losses are going down, so these BBB bonds look better and better. But eventually, something comes to a halt. At some point, the actual economics underlying that you actually need homeowners who have income to pay these mortgages, catches up with you, and they start defaulting on their loans despite the fact that home prices were still going up. And then that shock spreads back through the system. Right, so the home prices stop going up, loan origination falters, the BBB bonds start having losses associated with them and delinquencies, and then all of a sudden that ratings arbitrage doesn't look quite as nice as it did when you started out. So, just a random set of thoughts I had. I don't think anything like that could ever happen. But so how do we balance the benefits and risks of these different techniques we've developed, the securitization, structuring, and derivatives contracts, so that we get the benefits which are clear without suffering the consequences that might arise.
The answer to that is?
I don't know. Yeah, we're only in the questioning phase right now.
As both Andy and what's your name? Roy and I speak. It seems like about every other month together on some panel or some session someplace. I guess they just book us together all the time. As both of them said, this is a paper that's kind of in the early stages, and in part what we're looking to elicit today, elicit is another word almost for participation, what we're looking to elicit from the audience are suggestions for the direction and the route that the paper should take. What kinds of questions maybe are we missing, because we all have our own individual prejudices, I think, associated with it. But you should feel free, particularly as we're winding down in the last half hour or so of this, to speak up if you disagree with something, or if you think that there's something that's being missed someplace. I think that Andy went through some very interesting things associated with categorization of various risks, and talked about how that may affect the pricing of instruments. And I just jotted down a few of them that he talked about: funding, prepayment, structuring. He maybe didn't say legal, but I wrote it down, and operational. But I think we also generally think about market risk, and we think about liquidity risk, and we think about counterparty risk, and for some reason we seem to think about all of those things as separate, even though they're all bundled into one thing. And that one thing that they're bundled into is price, or at least in theory they should be bundled into price. It's not clear that all of these risks are necessarily captured in price, and in part that may also be a failing of financial engineering, in the fact that I don't think generally when we're doing our modeling or trying to develop how we price instruments in the marketplace that we necessarily give due course or due attention to all of the various components of risk that may exist. Even, for instance, liquidity risk. While with certain types of instruments, people may try to price in liquidity risk as a separate component, but generally we're not very good at it, and we don't have a very advanced toolkit associated with trying to embed these types of risks into price. But I would argue that market risk should reflect, or that market risk, liquidity risk are probably almost two sides of the same coin, but everything should be reflected in price if we can get there. Ideally, we'd like to disentangle those things. We'd like to separate them out so we could maybe hedge them separately, or deal with them as separate types of products, or share the risk. But that's a very hard thing to do. So price discovery, which is one of the topics that I'm supposed to talk about, is clearly at the root of much of how we should be thinking about risk. And I think generally, with most instruments, when we're looking at price, and when we're looking at the volatility of the time series and the sequence of prices that we've observed, we're generally thinking about that as the I'll call it market risk, I don't know, the asset price risk, what's the value of the asset, when maybe it's also incorporating, or imperfectly incorporating, some of these other types of risks. And somehow I think we need to begin to think about ways to disentangle those various components. I also think that, and there are a bunch of questions that the working group has put together, there is a focus right now, probably driven partly by the events of the last 18 months or so, on what I would call instrument liquidity. So if we're talking about securitization, we're really talking about whether or not those instruments are liquid, whether or not you can sell them fast enough. Much of what Roy talked about was also whether or not you could sell when you needed it. As he and I were chatting before the session, liquidity is something that you only need when you need liquidity. So it's kind of something that's worthless all the rest of the time. Nobody wants to pay for liquidity if they don't have to, except when they want to. So there's a focus on instrument risk, but clearly in the light of the last 6 months, firm risk or firm liquidity has to be a consideration. And sometimes people argue, well, capital, and indeed, from the regulatory standpoint, that's essentially where we were as regulators, where we are today, where the regulators are today, is that you have to meet certain capital rules. Well, clearly capital rules don't apply, because the capital isn't as important as the liquidity, and the liquidity doesn't depend just on the capital, it depends on what you can do in the market and how you can transact. I don't think, I know from my time at the Commission and dealing with the international regulatory community, no one ever thought that you wouldn't be able to borrow overnight on U.S. Treasuries. So if you can't borrow overnight on U.S. Treasuries, what does that imply for liquidity? Is that liquidity associated with the instruments, or is that liquidity associated with the firm, or is that liquidity associated with a counterparty? One of the other things that I think people don't think enough about are clearing organizations. So now, of course, in the light of what's happened, everybody's saying, well, we should find a way to take these OTC derivative contracts, we should run them through some type of centralized clearing. Beautiful solution, easy solution. Except how do you do it, would be first question. But the second question is who can pay for it? Because the way clearing organizations actually work, and regulators should know this, but maybe don't spend enough time thinking about it, is that it's essentially a mutualized insurance company. So the street firms all post a certain amount of money into this clearing organization. I was on the board of the Options Clearing Corporation, so I'll just use them as an example. I think it's a fine institution. It's got fine credit rating. I'm not trying to say that there's anything wrong here. But what you do is you have members of the clearing organization, each posted based on essentially their volume of activity, capital, into the clearing organization. Clearing organization has sufficient capital, and it has a call on any of the members. So first, if a clearing member fails to meet its obligation, you try to get the money from the clearing member. Second, if that clearing organization doesn't pony up with the money, then you tap into the clearing pool, the reserves that you have, this mutualized insurance policy. And if that's insufficient to meet the clearing needs, then you go around to all of the other clearing members and you say, we need some more money. We put a call to capital out. Now, that's an interesting point. Now, this has not happened any place yet in the world, really. But when you go around to those clearing organizations, when you go around to those companies that have posted capital in the clearing organization, it strikes me that while they have a contract, they also have a decision. And that decision is they can choose not to meet that capital call. Generally, they're required to meet it at least once. They may not be required to meet it the second time. But generally, they're required to meet it once, or they can drop out of the clearing association, which, of course, is a choice. And if you think about a very large meltdown scenario, clearly that could happen. That's what's generally known as good to the last drop clearing, because you can always go back and get more money in theory. It poses a certain amount of counterparty risk to the members of that clearing organization. And the reason that I say that it poses that counterparty risk is because they're essentially exposed to the risk of other members of the club, of that clearing organization. That's versus some clearing organizations in the world, actually, the amount of capital you put up once it's gone, which means, of course, if there's large enough transaction or a large enough problem, the clearing organization is gone too, and then you don't have to worry about your capital, I guess. But that market probably doesn't exist anymore. That's another form of liquidity that perhaps people don't think about very much and haven't thought about what the implications may be. Either the fully paid clearing, the second one I talked about, or the good to the last drop clearing, the first one that I talked about. And one of the reasons that that may be germane is that if you look at clearing organizations, in this world of increased competition, of stock exchanges and other markets where everybody wants to go public and everybody's busy doing other businesses, if you look at these staid, conservative, under the radar clearing organizations, I'll take one here in New York called DTCC, which clears equities, you might be interested to find out all the other lines of business that they've gone into. And those lines of business are not regulated lines of business. They are indeed profit-seeking business opportunities. And those profit-seeking business opportunities, you hope, are ring-fenced, walled off from the clearing. But, if you run into some problem, I believe management probably only has a certain amount of attention they can pay to one thing at one time, particularly when there are crises or problems. And the same type of thing happens even if they're not pursuing for-profit opportunities, because sometimes decisions are being made at clearinghouses to offer new lines of business or new extensions to try to support smaller clearing members. And those smaller clearing members may actually pose risk to the larger group. Another form of liquidity to think about. And then, so I started with the instrument, I then went to a firm, I went to the clearing organization, and then finally I'd say one of the types of liquidity that we have to think about is a systemic liquidity. We talk about systemic risk a lot. Maybe they're almost the same thing. But really, what happens if there's not enough liquidity in the system? If there is a closure or a failure of markets, which is generally what I would consider to be kind of a systemic type of liquidity event. And we might think that when we look at the mortgage market of the last year that, that was a market which really didn't trade, so of course it was never liquid. It was just something that was supposed to sit on balance sheets or in investment portfolios. But I don't think you can underestimate the idea that liquid markets can also become illiquid relatively quickly. I already mentioned the fact that the U.S. Treasury market, at least during the final days of that final week of Bear Stearns' real independent existence, froze up. So that all of a sudden was what we considered, I think, to be the most liquid market in the world. Maybe currencies are more liquid, I don't know. Was not liquid anymore, where German government bonds were rated higher than U.S. government bonds, at least for a time period, presumably because they were liquid. These things make a difference. And part of that, I think, may also be a result of financial engineering. Let me give you an example that I've thought about in this credit liquidity crisis. One of the things that we saw an impact or a reflection in the equity markets that we perhaps hadn't seen before, particularly that came out of the credit default swap market. And the way that I look at this goes back to price discovery. That when the credit default swap market started, choose your number, 8 years ago, 10 years ago, to have any reasonable size, the way that we priced credit default swaps was entirely off of equities. We basically, whether you use KMV or you use Bob Merton's approach or whether you use Bob Giro's approach, all of these rely on the equity markets for pricing, for determining what the volatility, what the liquidity is. You're unrolling the option for the firm based on what you see the price of equity. But as that market got larger and larger, as it grew very rapidly, lo and behold, that market started to have price discovery of its own. And when it had price discovery of its own, no longer was that price discovery just coming from the equities market and being reflected in the credit default swap market. The credit default swap market started to be linked to the equities market in a way that many people didn't expect, and then found out about last summer when it hit the equity market from the credit default swap market. And that's really a matter of the fact that when we developed the product, as financial engineers had a part to play in it, it's a great product, great idea, but we didn't think about perhaps the linkages as the market matures as to what the impact on other markets could be. So that's one of the types of things that we should think of. There was an interesting quote this morning by one of the panelists that talked about structures, and it said that the structures you can create are only limited by your imagination. In part, that's the problem, because the fact that you can create these structures and they're only limited by your imagination. As Andy said, of course, if they're very customized, they have no liquidity. And if liquidity is something that you're seeking, it's probably not the appropriate way to go. And then I think that Andy also said, I'll pick on him a little bit, that they were talking about pricing off the ABX market not because it was the right thing, but because it was the only thing to do. And I think somebody this morning asked a question about how do you price weather derivatives, or how do you go about modeling the weather derivatives. And this is another perhaps failing of financial engineering, is because it's not the right thing to do, but it's the only thing to do, so we use it. When you price weather derivatives, someplace somebody's assuming that there's geometric Brownian motion in the changes in weather, I guess. You can apply a bunch of modeling to get the mean and standard deviation, but in the end, you're assuming geometric Brownian motion. I don't know that that's true. When you model, the spark trade, you're assuming geometric Brownian motion someplace, with electricity demand and with natural gas supply or demand. All of these things we're doing because we know how to do them. It's the best tool we have. Well, maybe the best tool we have is something that should make us pause at times and make us think about what it is that we're doing and what the implications are when those underlying assumptions are inappropriate, where it's not the right thing, it's the only thing, but maybe we should do something different, or maybe we shouldn't do it. We had talked earlier about the idea of arbitrage and whether or not trades are arbitrage reducing trades or not affecting arbitrage, and Andy gave a very good exposition of that. One of the things I worry about with financial engineering sometimes is whether or not there's any arbitrage there at all or not, or whether or not we're just using financial engineering to create a new product that sounds really good to sell to an end customer because we can sell it. So is it actually fulfilling a market need, or is it fulfilling a marketing need?
A marketing arbitrage.
It's a marketing arbitrage. That perhaps is an area where we should think about our contribution. Thanks, Rich.
Can I just ask a question about the goals of this committee?
No.
Because, you've proven beyond a shadow of a doubt, at least to me, how important this topic is and how complex this topic is if taken in its entirety. I'm afraid that we as financial engineers might be making this more complicated and certainly more longer term than the world can wait for. And I was wondering if the committee's given any thought to, I personally think what the accountants did with stupid level 1, 2, 3 is at least a start. It's a nomenclature. It gives people a handle to have a conversation. Have we considered, before you come out with this paper that's going to solve all the problems of the world in terms of both firm level liquidity and individual security liquidity and the impact of financial engineering, doing a first step that's pretty simple and developing a nomenclature that people can sort of begin to adopt as a framework?
I'll leave that to the committee.
I think one of the things we're doing is trying to figure out what the questions are. So maybe that's a step in the right direction. But yeah, do I expect that we're going to come out at any point in time with all the answers? Certainly not. I think,
I thought that's what Chester was going to write the answers. We gave him the question.
and that's what he's doing on the beach in Hawaii. That's a good suggestion, I think, to the extent that we can even identify what we think are, the basic challenges that we're dealing with is a step in that direction.
But even if you could take the three, Rich talked about price transparency. Even if you took a matrix that maybe expanded at 6 to 9, and then you had like 3 or 4 columns based on liquidity and bid offer spread characteristics. But I think if you could do something short term that gave everyone a handle of how to talk about the different kinds of instruments in terms of a trade-off between price discovery, liquidity, transparency, and complexity, and got that out relatively quickly, you would have tons of people, A, very appreciative, and B, very anxious to join your committee and help you solve the big problems. That would just be a starting point. So I just think something concrete quickly would be more valuable than the perfect answer a year from now.
That's a good suggestion. We should think about that. We should have more of a conversation about that offline.
Okay.
Couple of the challenges, and it kind of is a good lead into what I was going to talk about as the last part of this, was we, in some ways, one of the challenges of financial engineering is we like to come up with exact solutions. We like to come up with, and those may be, we like to come up with quantitative solutions, let's be honest. And a lot of the cases, the next session, the third part of the paper, I think we called it evaluation and risk assessment. Another way to say that is model error. And that's really what we're dealing with here, is because I think we try to put too much precision in a lot of these models and a lot of these, the models, if you kind of go back to the, how they were and why they were developed, they were tools. And a good model usually gives you some pretty good insights. The problem is that sometimes the models can be terribly wrong, and that's what we're dealing with here, is how bad can these models get. I'm not smart enough to sit here and figure out what the kind of the 3, 4, or 5 major points are that we need to kind of divide this up into. I'm sure there are people out here that can help a lot in that process. It's, in some ways, I think the danger is sometimes that as we try to add this level of precision, or we try to add this, this number or this letter, and I'm going to use the word letter here very specifically, because what I want to talk about is ratings. Because I think that's a situation where we are, a lot of problems that are as part of this process right now come from a extension of the use of credit ratings to things that they were never ever dreamed to be used for. It's, just timing's nice. The Wall Street Journal today had an article that says, SEC aims to rein in the role of ratings. And if you talk to a number of the people from the SEC over the last several months, this has been an ongoing phenomenon, and it's one that is obviously being reactive to the role that they've played in a lot of these processes. A couple of the things that they highlighted in the article was, that now money markets are, potentially no longer going to be required to only invest in highly rated securities. They're going to allow some judgment in the money markets. Now, we have somebody shaking his head down here, and there are obviously we're going to have, you probably are leading to more money market funds breaking the buck as part of this. But the idea was to at least make them think about what they're doing as opposed to having a rating. They're also saying that the investment banks, their capital requirements should be less determined by ratings of their assets. Now, one of the things we talked about arbitrage, and Rich's point, I think, from an economic perspective, it's always hard to understand any kind of enduring source of arbitrage. And that's, and it usually, and they tend to go away, and sometimes they usually go away sometimes in bad ways because people push them to the point where not only have you, bid away the arbitrage, but you bid away that to try to get out of your position, you're going to lose money. There are two sources of arbitrage that I think are important parts of this. It may depend on how you're looking at. One is, and I think this is kind of almost an oxymoron, is ratings arbitrage. And I'm using ratings arbitrage a little bit different, I think, than Andy did in his. I'm talking about the fact that you design these securities, you design these structures in ways that you basically can get Moody's, S&P, whoever it is, to give you the rating that you want. There's a model, it's driven by, they all have a sense of what the models are. And there's some really smart kid who's basically putting together a stream of cash flows, which is just going to beat the hurdle for a AAA rating by this much. Okay? And that's based on a lot of assumptions. That's what you're dealing with here. And that rating arbitrage, in some ways, is a way of sort of trying to get, it's like trying to trick the rating agencies. But these are things are built into this whole process. Because why are they built in? Well, they're built in because a lot of the structures have ratings requirements. If you break a rating, it triggers, or it's a tripwire, requires people to sell things. It basically allows the structure, to have been sold in the first place, and it's based on a rating, a letter. Okay, or in this case, 3 letters. You also have a second source of arbitrage, which I think is an important component of this, and that's regulatory arbitrage. Regulatory arbitrage that I'm talking about here in particular are capital requirements. Now, we talked about, I mentioned that, one of the big banks had basically was holding 80% of these securities on balance sheet. How do they do that? They do that by the fact that, now let's kind of go through some of the arithmetic. You have Tier 1 capital requirements, 4% for banks. If you basically have a AAA security, at least based on Basel II, the risk weighting, which is essentially how much of the asset counts from a leverage point of view, in at least some cases is 20%. So do the arithmetic. There's a lot of leverage that you can provide behind a 4% Tier 1 capital equity. And, the fact that you only have to count 20% of the asset anyway as part of the portfolio position. You can hold a lot of that asset. But it's important that those assets get a AAA or at least a AA kind of rating. If you have a BBB rating, you can't get nearly as good a capital treatment. So, there's a regulatory arbitrage going on here. If I can manage to get these securities that I'm going to only hold anyway into a position where I can effectively, put them on my balance sheet, but tie up virtually no capital to do it. And somehow or another, I can basically earn my cost of financing, which is a separate issue that I'm not going to even try to deal with here. But let's assume I can do that. Okay, what I've just basically done is I've managed to allow myself a way of basically then arbitraging your own regulatory position and allowing you to expand your balance sheet in ways that don't use up a lot of capital and allow you to generate a lot of fee income.
Right. So I would almost say that financial engineering and rules-based regulation are at odds with each other, and
That's
something that sort of supports the arguments from regulators from time to time, trying to just ban all derivatives. Right? Like a lot of times you just hear regulators say no derivatives allowed in any fashion whatsoever, because they know it's going to provide a mechanism to get around whatever rules have been created. And if you go to principles-based regulation, then presumably you can get around some of that. The question is, do you have enough people with the judgment to enforce the principles? Because typically if we look at our regulators, while there's some very smart people in Washington at the policy level, as you get down to the actual people doing the supervision, you find sort of the quality level and the knowledge levels declining. So we'll sort of end up in that context.
That's always going to be a challenge in this. There's no doubt about that. One of the things, though, is there has to be some middle ground in between these. I mean, the idea that we're doing it all on judgment or we're doing it all on one letter, that you pick a rating and one letter fits all, is not a system that necessarily works. I mean, just think of 2 securities which have one that has a probability of default of 10%, but in the case of a default, you're going to have on average a 90% recovery rate, versus another security that only has a 1% probability of default, but if it defaults, you lose everything. That has some very different implications as you get closer and closer to a potential default. And it has very different portfolio perspectives. It has very different risk management implications. But we seem to have blended this into this one letter. Okay? It's also the case that we pushed this. It used to be that we thought of, credit risk as being kind of this idiosyncratic, firm-specific, what can go wrong to General Motors type of risk. What we've done, though, is with this evolution and this role of a lot of the structured products and the reliance on ratings, is we've basically moved away from that to a situation where, in many cases, we certainly have found, at least after the fact, that there was a systematic component to the prices and to the ratings. That was, things tied to real estate prices, if nothing else. And because it was systematic, it had the potential, and it was spread through so many portfolios in ways which people didn't understand the potential correlation impacts, that it became a systemic source of risk. Credit rating errors, model errors as part of the process became a source of systemic risk. It used to be, at one of these panels, there was this panel discussion, an IAP panel last summer. They had Bob Merton and Myron Scholes. And one of Bob's quotes was that it used to be the case that you didn't spend a lot of time on AAA credits. You didn't put your best analyst evaluating AAA credits. It just wasn't the right business decision within an organization to evaluate the AAA. But in this particular case, given the size of the potential positions on the balance sheets, given the potential for much higher correlation than people perceived as part of that, that was a faulty assumption. The fact is a lot of the exposure, and by the way, this wasn't the quote, dumb money that was doing this. This was, a lot of this super senior AAA, it turns out, were on the balance sheets of, the biggest, and most innovative, investment banks and commercial banks. So these were people they were basically, they were drinking their own Kool-Aid. And when you deal with that issue, all of a sudden, again, that's an exposure that we're dealing with here. The sources of errors, okay, if you kind of look at ratings, that's been the most obvious issue that we've been dealing with, are these systematic or systemic sources of errors as part of the process. But let's step back from that. Let's assume that this was kind of a one-off type of thing that we went through this, that, okay, from now on people will realize that real estate prices can go down, and that, and this was probably an extreme case anyway. But then if you think about how we're using these from a risk management point of view, you're dealing with, it can't make any sense to be relying on something that has the stickiness of credit ratings. Credit ratings should not go from single A or triple A to triple C in one step. Okay? Unless there happened to have been an earthquake. Things didn't change overnight in that sense. There may have been an event that triggered this, but again, there were things leading up to that. Okay? If the ratings aren't going to change more frequently than that, that has some real implications for using them as part of risk management. And if they do change more quickly than that, it has some real implications for how you embed them in structures or as tripwires. We've gotten into a number of cases where you're hearing stories about, well, the rating agencies are caught between a rock and a hard place, because if they reduce the rating, they're going to have to reduce it even more, because that's going to trigger a set of events which, their rating reduction in the rating is going to trigger a series of events that they can't necessarily get ahead of. So that in itself is a source of instability as part of this process that you have to deal with. The second point, in the same spirit, is, we started with a rating on a corporate credit, okay, and maybe it didn't make a lot of sense to have everything embedded in one particular number, but we like to do that. But again, it doesn't make sense from a risk management point of view when you're using the same letter ratings across all sorts of different markets with all sorts of different risk characteristics, and saying that I'm going to embed everything in this one letter. It just doesn't make any sense if you kind of think about it from the perspective, if nothing else, how they got to that letter and what were the inputs that led them to that. At first pass, it would be better off at least to tell me what you think the probability of default is and what you think the expected recovery rate is, as opposed to just telling me that it's a single A credit. That they should be doing that, providing that information to come up with the rating. If they're not, then you kind of got to worry about the process even more. But so if as a starting point, we're talking about price transparency. We're talking about transparency as part of the whole process, and yet we have so much built around from a financing point of view, from a regulatory point of view, ratings. Why not we need more transparency in those as well. We are kind of taking more time than we planned on, so why don't we open this up to some questions from the audience or comments?
It seems to me that one of the obvious financial engineering solutions to this has already been thought of and failed. I'm talking about the SIVs. I always like SIVs because instead of designing something where you didn't even think about that, if you explicitly going in and said, okay, we might get into trouble. If we get into trouble, here's exactly what we're going to do. We're going to have a fire sale. We're going to have certain times. We're going to hit certain triggers. We're going to allocate things in a certain order. And everybody buying it in principle knew where they stood in line and how this worked. Any thoughts about why the SAVs were such a complete disaster? The first thing that went, and probably the number one thing people hate about what happened last year.
I can give you 2 points which I think led to that. And again, one is you still had to deal with the whole issue of forced sales going on and the implications of that. And the other, as part of that, the implications of those forced sales, not just for the SIVs, but for all the things still left on balance sheets throughout the system. And the second one was, which may or may not be fixable, but it basically was, I think there was a lot of uncertainty as to really how much non-recourse there had been built into those systems. That whether or not that the banks could really legally walk away from those.
Yeah, I think it's a general issue. I think sort of relates to sort of financial engineering and modeling. Is that in modeling all these instruments, we assume that there's like a fair value for an instrument based on some theoretical approach to modeling it relative to other instruments, and that the market price might vary somewhat from that due to some concerns, but would never be, totally unrelated to the value that we would arrive at in that form. And so we've turned our whole economy into this sort of mark-to-market economy, and it turns out if you try and liquidate an entire mark-to-market economy at one time, it doesn't work very well. And I think the people who were invested in the SIVs sort of relied on the ratings and on the issuer and didn't really look beneath that to say what risks they had. So they were shocked to find they had any risk, right? Because they were told they didn't have risk. They said this is a pool of assets, it's diversified, there's these liquidation mechanisms, you're never going to lose any money. And so if we're never going to lose any money, we don't have to think about it. And one of the fundamental assumptions behind that, which was that you could actually liquidate the assets as things started getting worse. So so the same thing that did in portfolio insurance didn't hold. And I think that's one of the conclusions or thoughts that's going into this paper, is that in modeling financial instruments, we have to start thinking about a theory of liquidity and how that theory impinges on our theory of how these instruments work. That it's no longer sufficient to say, well, just because there's a value there that changes according to some distribution that you can execute at any point along that continuum, that there's many situations, or at least one that we've never experienced, where you can't execute the transactions that are behind the theory of creating these various products.
I think there's also what John O'Brien was calling this morning the fishbowl effect, and that is everybody that operates within the market acts as if they're in their own little fishbowl, and they're not taking into account maybe the overhang that exists in the market. We clearly saw that in '87 with portfolio insurance. We really saw instruments. We saw it with LTCM. We've seen it repeatedly in manifested in these kind of liquidity crises. And even if you've got a bankruptcy process set up, it doesn't kind of resolve how quickly these things can unwind. Although I want to inject here that one of the things I was thinking of earlier when Roy was talking was, I wonder if you could package an instrument where you actually lined up a buyer in a crisis ahead of time, and said, so you find a buyer who understands the instrument because it's been put together, and says, okay, if this happens, I'm willing to buy it at a 20% discount, arbitrary 20%. But that would clearly resolve. So obviously, it would have to be a good counterparty, et cetera. But it might be interesting.
And it actually would be a great signal because, I mean, it goes back kind of to Grossman's 1988 work in terms of the use of options as opposed to dynamic trading as a way of kind of, doing the replication by ex ante before the fact, before you have to pay the fire sale type of prices. It certainly would be the case if you had to, if it cost, 10% for that put option that's 20% out of the money, it probably makes it a difficult transaction. And if you need liquidity, maybe you ought to ask yourself why it costs so much to find that, why it would be so costly to get a buyer at something which was at a price which, given today's market, would be one there where you thought it was a very, it ought to be a very attractive alternative for investor. If you think it's valuable at this price and you potentially need liquidity, it's the use of puts as part of this process is one that, you, at least the ability to try to the ability to at least think about buying those puts ahead of time with a reliable counterparty is an issue that certainly could be related to this. Now, the problem is in most cases those puts typically would be very expensive relative to the quote arbitrage that you're trying to exploit, and maybe that's something you have to ask yourself about in general.
Are we predestined to have one of these debacles every 10 years? I mean, you mentioned portfolio insurance, long-term capital. And each one of those we have, some of the most brilliant minds. Hay Leland and Mark Rubenstein were involved in the first one, Myron Scholes in the second one, and a bunch of professors from both Harvard and MIT, by the way. Are we predestined? Is there anything we can learn from this?
I'm going to go to the table. Every one of these guys you're naming, I basically have worked with, so it's
Every 5 years.
That's the challenge on all these things is when you have innovation like this and you have, you're going to have potential excesses, and we certainly have had some of those. It's, what's on these panels that Rich and I talk about a lot of times, one of the things it's kind of interesting. You go up there and say, well, we solved the last problem. It's always a new one.
Here and elsewhere, I hear a lot of, well, we're going to need to begin thinking about this. And what I'm wondering is, aren't we going to need to create a mechanism by which, when you have the thoughts about this, something actually happens? And a good example might be, maybe if you hold yourself out as a financial engineer and after the fact, it turns out that you weren't thinking about what you needed to think about, you get that title pulled. You can't call yourself that. Just like if you're a registered representative and you do certain things, they pull that. And there's a public record of that fact. So I haven't actually heard anything in the last year that I didn't hear in prior years. It's just in prior years, it was thinking about it, not experiencing it.
Yeah, I think Jack Trainor's comment this morning is sort of the reason why that doesn't happen, which is that the person who stands up and says, don't do this because it's a bad thing, he gets either fired from his company, and the guy who says, hey, this thing's great, don't worry about it, their company gets more and more volume, makes more and more money. And, so the guys who are opposed or say, let's be conservative, they get squozen out of the market. So that's, to me, is the hard thing, is how do you overcome that? I mean, so the rating agencies were making tons of money off of these transactions, and if someone came and was like the new CDO guy, and he said, you know what, our view is that we shouldn't rate any CDOs, my guess is the rating agency was not likely to hire that guy.
That's right. But everything so far has been descriptive.
He's just saying
And
take away
it's
the
not
slide rule after the
prescriptive.
fact.
And what I'm saying is, maybe there needs to be a mechanism by which not being that guy terminates your career, right? If we care about being right, you mostly have to think about all the ways you're wrong, right? Right? You need to find you have to track down all the evidence that you could be wrong, and if you're going to try to establish you're right. So, might there not be value in having a mechanism by which, well, I'm going to ask you, let's just describe, what mechanisms could you imagine by which something actually happens, so that what you're describing, which is perfectly understandable given the current mechanism, might not happen in the future?
I would argue that there would be value in a mechanism, and I'll say from the IAFE standpoint, we've sometimes talked about whether or not there should be a professional certification, and you could follow then, of course, the engineering model where there's professional engineer in training, and then there's a professional engineer, and if the professional engineer doesn't stamp a bridge, the bridge doesn't get built. That's a large infrastructure for our organization at this point in time to build. But we'd be happy to talk about building something like that if there was indeed sufficient momentum from the field to support that.
I'd like to start with a comment on the last two comments, which is that I have a hypothesis that we're in a very innovative capitalist system. There are things that come up that are new and different all the time, and you never get it right the first time out. You don't see that you got a problem until a couple of years gone by, and then something happens, and you can look back and we can see, well, what problems did we see with portfolio insurance? What problems did we see with interest rate swaps? What problems did we see with credit default swaps? All of these contracts led to changes as we got more experience with them, and this is the same sort of thing as we're seeing now, I think. Securitization of mortgage-backed subprime mortgages and CDOs and so forth. It's a new thing. And it's an important thing, but we're not going to get it right the first time through. And I would say that how do we tell who has the right to call himself a financial engineer? Anybody who's been a financial engineer for less than 3 years probably is safe. But anybody who's been in the business, I would say anybody in the room who's 40 years old or older and has been on the right side on every major thing that's happened during your professional career, please stand up now.
We've got one now.
Can I just say something?
Yeah, I'll stand up for that.
Yeah.
Okay, basically, we as an organization, like many organizations in other disciplines, tend to create definitions. These definitions tend to be created many times after the fact, after things are in existence, add new things to them, and then these things end up taking on a different personality that was originally indicated. In defense of portfolio insurance, the first time it was mentioned, but not called portfolio insurance, was in the original Black-Scholes paper. Gave the entire outline of how to do it. Now, later on, people decided to leverage that and include options, as opposed to staying just in, let's say, the cash markets. Now, if you were just in the cash markets and playing in the world of portfolio insurance during that crash in the 80s that we seem to keep bringing up, it had no problem. It made it through. Because basically, well, there was one that I created that kept running and worked. Maybe the one you did didn't. But in any case, essentially, it was the market bifurcated. It gave different implication of what prices were supposed to be. Now, the original concept, even of a portfolio insurance, was it worked counter to what the world was doing. People in buildings like this, for the most part, have concepts of overbought and oversold. This has something to do with values of securities being determined that either the market's wrong or we're wrong or something, but we're going to take advantage of that. The portfolio insurance actually operated as a source for that. Here, it was buying when others were saying, well, it's bad, let's get rid of it, or they were selling into a market where a group was saying it's not worth anything. Now, clearly, I mean, we have to be careful with how we include definitions going forward.
No, we definitely do.
We create some of our own problems.
And, you know, the debate, and I promised Leslie last word, so.
No, I just wanted to say, Steve, that I disagree that some of this stuff is new. Remember kitchen sinks in 1994? Remember when money market funds almost broke the buck the last time around? Remember what a kitchen sink was? It's when you took a mortgage and a CMO, and you stripped out the IO and PO, and you had these little bits left over. And so you put them into something called a kitchen sink. And then someone got the clever idea, well, instead of just taking these random pieces and putting them into a kitchen sink, let's put kitchen sinks into kitchen sinks. Now, how is that different than a CDO squared, except it's old-fashioned and old? So I'm saying, I think one of the big problems is those who don't learn from history are forced to repeat it. And I'm afraid that we as financial engineers, who are very precise and sometimes don't think sufficiently far out of the box to recognize the big picture patterns that keep repeating themselves over and over and over again. And that's why I come back to my point you were before. I think instead of trying to solve the big problem, if you would take it in little teeny bits and make a contribution, I for one would appreciate that very much.
I've been told by David we have a couple more minutes. Steve, I'll give you.
I actually had a different thing that I really wanted to talk about. I'm not going to answer Leslie at this point. We'll talk later on. But the point you made, I think I would like to emphasize and suggest this is a good direction to go for this liquidity risk committee, which is that we have tended to take bond rating as being the single dimension of risk, single measure of risk. And what we discovered is that, there's another aspect of risk that is liquidity related, is not related to default risk. I mean, if we figure AAA means you're going to get all the payments they promise, that's fine. And I don't think that there have been many actual defaults on things that were rated AAA. Maybe a few, but very, very few so far.
CDOs are all going to default. Every AAA
Well, that remains to be seen.
Every single one. No,
That remains
every
to be
single
seen.
one.
But
You
the
couldn't
real issue is that these people bought a AAA security saying, I'm absolutely safe, and then leveraged themselves a lot and discovered that if you can't price them in the market, you can't get people to roll over the financing for you. And even if that thing ultimately will pay every single penny it promises to pay, you can't carry that position. You're going to go out of business. Not because the default risk was badly evaluated, but because there's another element of risk that has not been, that rating doesn't cover. And so I was going to propose we need another separate system of ratings. We need the ratings for default, and we need maybe a separate set of letters or numbers or Greek letters or something for liquidity.
So,
the last point I want to make on that with regard to this, everybody is comfortable with the idea that you value a mutual fund at net asset value. That is to say, you're going to take, I own 1 million shares of General Electric, and I'm going to price it as if I could sell every one of those 1 million shares at today's closing market price. Right? So treating no liquidity risk at all in actually valuing that portfolio. But if you think about it, you couldn't possibly do that. And so the reason that we're okay with that is that we know there's a tremendous amount of liquidity in the stock market. There's much less liquidity in these markets for CDO tranches. So stocks should have a higher liquidity letter than CDO tranches, and that would give us a better way of getting all these two different dimensions of risk.
Well, and as part of that, I think, we didn't even talk about it, but one of the issues that lies behind so many of the things that we're dealing with is the roll leverage, and more specifically the risk of the financing or the risk of the funding. And, a lot of what happened over the last 6 months to a year, especially in the mortgage markets over the last few months, has been, pulling of lines of finance and, pulling of repo, and those things basically forcing the selling of these things. And what also somebody commented about, looking at this in a fishbowl, it's not just across the different market, it's within the same company. You basically got the people in the prime brokerage on the repo desk pulling the lines by marking down prices dramatically, then finding out that their banks got a lot more of that on their own books, and the SEC is basically saying, if you market there at this price, you got to market here at this one. So getting the money back cost them a lot of money.
This question is for Richard, and I acknowledge that it's been 18 months, but do you have any sense of whether the ESSC entity was in violation of the Net Capital Rule 15C31 and 33 on March 14th? And if they were, and JPM hadn't stepped up, do you think the SIPC insurance and that backup consortium insurance would have covered the shortfalls? Do you think that would have worked?
Well, I don't know the answer, but I would bet that they were always in capital compliance.
And on that note, I've been told that I have to cut this short. Thank you very much.